up next, the global and domestic investment landscape is constantly shifting, presenting both opportunities and challenges. For family offices, understanding these evolving dynamics across various asset classes in paramount, our next panel will explore the current trends and future outlook for family office investments, touching upon diverse avenues from traditional assets to alternative strategies. We have an exceptional panel of experts joining us. Mr. Amol Sathe, Head Global Investments, Mephezalea, a single family office. Ms. Sheela Kulkarni, Head of Market Development and Institutional Investor Relationships, World Gold Council. Mr. Vaibhav Sanghavi, CEO, ASK Hedge Solutions. Mr. Vishesh Narang, Head Family Office, UKPI, promoter of Berger Paints India Group. Guiding this diverse discussion will be our session chair, Ms. Jainy Shah, founder, Prime Star Investments. Please join me in welcoming our distinguished panelists. Can we have a big round of applause?
Great, it's amazing to see you all here. I welcome you all to this panel discussion on evolving investment landscapes in the family office space. We all know that family offices today are evolving from the generic wealth management role to a more evolved role as a business catalyst, investing actively in startups, tech, and even global markets. However, the global markets and the investment landscape has made it so challenging for us today that these investment trends are changing rapidly. Each of the family offices are responding to these trends in very diverse and innovative ways. So what we have here is a great panel, all of them being frontrunners and pioneers in how they're managing these evolving trends. So let's straight dive into the topic. I'll also be opening the floor for questions, so please feel free to ask them at the end of the discussion. So to begin with you, Amol, you know how global markets have been looking attractive. Increasingly, family offices are allocating. However, according to me, India looks the most attractive destination today, for the next 5 or 10 years also. So do you really think it's necessary to diversify into the global markets?
It's a great question, and I usually I get it a lot actually. See, the thing is, so I'm managing a portfolio of a family office which is spread across 4 continents and 6 currencies. So the thing is, why is it necessary? It's a very common thought process in Indian entrepreneurs as well as the family office principles that we understand India better, right? So we are here, we understand it better. So anyway, why go somewhere else where we don't understand that market quite well? Now, when we talk about attractive investment destination, we always talk about the prospective returns coming out of it. As a basic logic I'm talking about. So it's basically about the returns that I can generate from Indian investments and vis-a-vis the returns I can generate outside India. Now, many a times one important part is overlooked, and that is how much risk we take. Returns for me have never been returns in absolute term. They have always been risk-adjusted returns. So, think of it this way. If the family's business is in India, or entire portfolio is in India, across diversified asset classes, I understand. You can diversify equity, fixed income, alternatives, etc. But you are still subject to one particular risk, that is regulatory risk. And simple example I'll give, in 2018 the capital gains tax was reintroduced at 10%. Large portions of family office portfolios were affected, because after all we are looking at post-tax returns. Now, if that diversification is done across geographies where the tax laws are different, you are actually diversifying on the regulatory risk parameter. Your regulatory risk comes down. That is one. Secondly, in India, the markets are quite shallow as compared to the overseas markets. Like you look at Europe or the US or all the developed markets, Japan, you will see a lot of depth in the market. Now tomorrow if you want to hedge your portfolio and write an option which is 9 months in tenure, who's going to buy it? You will get no liquidity for that. So you need that market depth to effectively implement your risk management strategies. Now that market depth is not present here, but it is present there. And the third thing, that the arena of investment options, like hedge funds, again, it goes along with the second point, that why these hedge funds are able to deploy these kind of exotic strategies is because the market depth is there. So they can, and there are no capital controls. People can do interest rate swaps in 2 sovereign bonds, or two different countries they can do the swaps. You cannot do it from India. There are capital controls, there are regulatory problems. So this is where you can access these kind of extremely risk-efficient instruments, where you can actually get a lot of good risk-adjusted returns. And that is not available. These products are not available in India. That's why you can, you should rather diversify across the globe, different jurisdictions, different markets, different attributes to the risk and returns profiles of the investments. So this is my perspective I wanted to give you, why the diversification is required.
Great. So that basically means that the way the investment landscape is changing. Would you say that there are some investing asset classes or some emerging trends that family offices should not ignore for the next 2 to 3 years?
Yeah, in India, especially if you are asking, in India, there is the InvIT space that I would highly recommend to every family office to look at and not ignore that, because I mean, couple of points why I'm saying this. One is that India is on a fast track of infra growth. So the infra push is already there for a long time. We are seeing a lot of road constructions. We are seeing a lot of power generation and distribution space, which is experiencing rapid growth. Now here, InvIT is a space which is still not mainstream, by the way. Many investors are still not looking at it, probably because of, I don't know, it's not yet well established as equity market or a fixed income market, that kind of. So it's still a bit of a some kind of apprehension around it. But let me tell you that basically there is a great regulation in place for InvITs. So small example is that if the structure is the trust, then there is an SPVs who are holding the assets. The NDCF, that is net distributable cash flow that the SPVs generate, 90% of it needs to be distributed. And that is a regulation. So they cannot just keep hoarding surpluses. They have to distribute. So you can get great yields because of this. Right now, the high quality InvITs in India are clocking somewhere like 10 to 13% of yields. And all these are AAA instruments, and by regulation, they need to be AAA. So the risk-adjusted returns, again, you compare it with a high-quality corporate bond. What will it give you? 8%, 8.25 something. Here you are getting 10.5 or 11 at the same level of risk that you are taking. And this doesn't consider the potential capital appreciation. So you can also make a capital gain on it over a period. And while you wait for that capital gain, you are already getting the quarterly distributions. So this space is really, really good. Also, one needs to be really careful in choosing which InvIT you are getting into, because though they are all AAA, the prospects of those InvITs will have to be analyzed properly.
True. Thank you so much. Sheela, my next questions are for you. Gold being one of the most glittering assets today. Sheela, we want to know, in today's age and time of cryptocurrencies, private equity and equity, how does gold be a part of someone's portfolio?
It's a good question. I think if you look at portfolio construct today, what's important is to think about diversification, liquidity and volatility. And one asset class that actually gives you all three is gold. Simply because, gold behaves very differently to all three asset classes. And also the fact is that uh, gold is a good hedge against inflation. So when you also have periods where purchasing power gets eroded, or there is debasement of currencies, one asset class that keeps up is gold. You mentioned cryptocurrencies. So you know, crypto and gold behave very differently to each other. Cryptocurrencies as an asset do well when the markets are doing well, but when markets turn volatile, this is one asset class that takes a hit. It's like tech stocks, right? When markets turn volatile, you always see a downturn there. But gold is not like that. Gold doesn't behave like that, simply because gold is not a very volatile asset class. In fact, in terms of volatility, we've done some studies and we've seen that gold is definitely less volatile than a lot of asset classes, including emerging market stocks, REITs, or even cryptos. Simply because gold is a real asset, whereas crypto is ethereal. You know, you can touch and feel gold. And therefore, gold also has uses in real life, whether it's through jewelry, through technology, where even all your phones, laptops have gold, but also the chips that run AI servers also have gold. So it has a real use case. Crypto is mainly speculative, and therefore, you know, in volatile times, there is a flight to safety. And typically the one asset class that you would go to would be gold. So from a portfolio construct, what happens is gold actually is an insurance to weather all risks. When we've seen this in the recent past, where, you know, markets have been very volatile, and the one asset class that has stood its ground is gold. So, you know, gold is different from other asset classes.
True. Also, a big reason why gold is rallying today is where the world central banks are purchasing their gold and increasing their assets in gold. Why are they, what is the strategic reasons behind this, and what should family offices learn from this?
Sure. So see, central banks have been net buyers for the past few years. The last 3 years alone, we've seen central banks buying in excess of 1,000 tons annually. India is no different. So some of the countries that have been the larger purchasers of gold are Poland, Kyrgyzstan, India, China, Hungary, Turkey. What we've seen is that you know, central banks need to manage their reserves, and with the volatility that has been induced because of geopolitical and geoeconomic uncertainties, they're also ring fencing their asset classes, and if I may use the word, trying to move away from the dollar. The only other asset class which behaves like a reserve asset today is gold. You don't have any other currency that can match gold. So we are seeing central banks allocating more and more to gold. In fact, yesterday's news, if people have been reading, you know, most central banks have increased their allocation so much that, you know, gold is the second largest reserve asset in portfolios of central banks. India is no different. Consistently, India has also been buying gold. Last year, India was the third largest purchaser of gold with about 77 tons. We've added more this year to the tune of about 2.5 tons. So gold is a strategic asset, but it's also a very stable asset. From a central bank perspective, stability is very important. You know, they don't want some asset class which is very volatile. And we've seen this, you know, when the Russia-Ukraine war started and Russian assets in US dollars were impounded, there was no other asset class to look up to. So a lot of central banks, including a lot of Asian central banks, have started moving away from the dollar and moving towards gold. So Indian reserves now you know, dollar versus gold, we've got about 12% of our reserves in gold. So that's the allocation, and it actually is a sign of changing times, where, you know, the move is away from the dollar into another asset class, which is gold. So gold is also like insurance. It's a safe haven asset, a hedge against inflation, all of that put together. And I think this is something that everybody must consider if you want to have and ensure risk-adjusted returns in the portfolios.
Great. Sure.
One sentence I'll say about gold is the only asset which is no one else's liability.
So true.
It doesn't have a counterparty risk, right? Because it's nobody's liability. So that is the most important consideration. And in fact, you know, until a few years ago, gold was quasi-currency.
So an interesting thing I read about gold and the gold reserves. Indian households are one of the largest owners of gold assets. If you compare the top 10 global central banks, if I'm correct, Indian households have equivalent gold reserves to the top 10 global central banks. Please correct me.
Yeah, so our estimates are that Indian households have about 25 to 28,000 tons of gold.
Which is equivalent to the top 10 central banks' gold reserves. It is amazing how Indian households
Indians are very
always
clever. I think they know the value of gold and the role of gold, especially in times of uncertainty.
Very true, very true. So certain traditional assets are again coming back. With that said, I wanted to ask you about the hedge fund landscape in India. Though the hedge fund landscape is still evolving at a very nascent stage, still there is a lot of growth that's happened in the last 2 to 3 years. From your perspective, what is the kind of themes that are running in the hedge fund landscape, and where do you think the inclination is towards long shots or thematic or any other themes that are catching on?
Sure, thanks, Jainy. What we've seen from a hedge fund's perspective is one, of course, that the AIF guidelines, you know, supposedly which kind of enables the hedge funds to come into place, came in about 2012. And post that is when the evolution of hedge funds actually happened in India. Of course, the journey of 12 years or 13 years in that case has been short at this point in time. But I think what we've been able to do is basically to educate the distribution partners, the investors about the need of those kind of hedge funds. I'm just taking a step back and just trying to make the you know, overall macro environment about hedge funds kind of, you know, clear in terms of put those data on the table here. Is that from a global perspective, out of close to about 110 trillion dollars, close to about 15% is into alternate space, right? Now, within that 15% into the alternate space, we have seen more evolved investors, including pension funds, endowment funds, having allocation to you know, alternates in excess of 50% as well in some cases. So what we are seeing is basically more educated, evolved investors who understand risk-adjusted returns you know, much better, is where we are seeing increased allocation happening from the global perspective. Of course, now when you come to India, I think it's a long journey ahead in that sense. A lot of education about risk-adjusted returns has still to go in. I mean, you know, what we are seeing in a more encouraged basis is that education, that awareness is going up in that sense. And that is why we have seen some amount of evolving of products, innovation happening in the category 3 alternate investment funds, which is primarily the long short funds in that case. Now, where are they kind of placing their bets, or where are we seeing you know, investors kind of coming across is basically any product category which gives you an value add, both in terms of returns and risk, is where we are seeing interest. So for example, long short, when we talk about, is actually a tool to manufacture strategies across risk spectrum. It can be an extremely conservative strategy to a very aggressive strategy in your portfolio as well, depending upon how much net exposures you are taking, how much risk you are taking on the product, and so on and so forth, to actually achieve your financial objectives. We have seen good amount of interest on the extreme ends, both on the extremely conservative side and very aggressive side as well. Not very much on the kind of, when you compare in a traditional benchmark basis like a balanced advantage mutual fund kind of stuff, we have not seen much of an interest there, but from a conservative debt plus kind of alternatives to equity diversified alternatives as well is where we have seen maximum interest, purely because one, on the risk side, people want more returns. You know, while if you have an element of controlling of risk, then that's a very attractive proposition. At the same time, in the evolving landscape of debt, when the interest rates are down now, the bank rate is cut by 50 basis points, you see across the products, nothing is giving more than 4.55% on post-tax basis. So if somebody can give you more than 100, 150 basis points over and above that on a consistent basis with liquidity, we have seen good amount of interest, and which is why one of our flagship strategies within a 1 year is now more than 1,700 crores in terms of the AUM as well. So that's the kind of interest we are looking, from an hedge fund perspective.
Okay. So from the family office's perspective, if I were to say, and they're looking at investing in hedge funds, how does a hedge fund become a core component of their investment portfolio?
See, again, now what we are also seeing is, yes, of course, category 3 alternate investment funds are available, and kind of that gives you that stability in terms of your returns irrespective of your market conditions. But what is also one interesting trend we are seeing is basically many investors want to use those kind of hedge fund strategies or long short strategy on their own books. Okay? Why is it? Purely because they want to utilize the advantage of taxation into their own books in that sense, right? Because there is a little different in terms of the category 3 AIF has a little different taxation. Also, family offices, to our surprise, are seeking solutions from us to customize in terms of leverage, because they're looking for a kicker in terms of the returns as well, right? So this is a newer segment where we are seeing a lot of interest coming. We are, of course, customizing some unique solutions for them. But that's an area where larger family offices are adding value to their own portfolios. Apart from your traditional products, now I would say in our definition, the long short on a conservative basis on equity are becoming a little traditional, and advisory is moving to a newer level of innovation in that sense from a risk-taking ability, along with some amount of efficiencies on the taxation. So that is a segment which we are seeing coming about and adding great value on a net return perspective within their risk profile.
Okay. So from the global perspective now, hedge funds have diversified into various asset classes and strategies. What is one thing that India can learn from them and bring it to our markets?
In fact, category 3 funds actually are allowed to invest into various asset classes, including your commodities. Of course, there are some amount of restrictions, but I think this will evolve over a period of time. On a structured basis, if you go and seek a portfolio manager who is just managing commodities, you will not find much of a talent here, right? So I think it is some time to go still, where you can find a macro manager who can invest across the asset class. Till then, probably you will have to rely on quants more so, which is that your investments is primarily driven by data and not by subjective judgment in that sense. So a lot of reliance on quants will come in the first phase to enter into various asset classes, including your commodities, which is primarily governed by gold, silver, oil, and so on and so forth. So I think that is something which we will find more and more participating or more and more participation coming in, from a family office's perspective.
Okay, thanks. So this basically means investing as a landscape is becoming more diverse, more challenging. So now, Vishesh, coming to you, how is the next generation in family offices actually influencing this investment decision making? It's getting more complex day by day. But are they really getting inclined towards a higher risk appetite, or they're still tilting towards the comfort investing sides?
Thank you. So as far as the next gen family office, it really depends upon family to family, and the thesis, investment thesis, most of the time what we have seen usually stays the same, because if the patriarch is still there, he's kind of taking care of the overall risk, so there is not much deviation or risk level. And as far as the next gen's risk appetite is concerned, I think eventually all the risk appetite of everyone, when I started as a professional in a family office, my risk appetite, because I'm an next gen, was quite high, but eventually over the period of 5 years, it tamed down to a point which is realistic. So what I feel is that once you are seasoned enough to understand it, it will boil down to a same, like Amol was saying, risk-adjusted return scenario. And the next gens very well understand it. It's not that their risk appetite is humongously higher. The only thing is that they're able to spend more time to understand a product deep in detail. You may call a hedge fund, and you may take the definition of a hedge fund from the West, where, you know, but actually, if I go to Vaibhav's point, the strategy which he's talking about is kind of an absolute return strategy. For us, there is no risk in it. I mean, technically, how we look at that strategy is no risk. You may call it a hedge fund, yes, but it is even safer than an InvIT.
If you understand that well.
If you understand that. So that's where the next gen's major intellect comes into picture, is to understand a product, spend time on a product, understand deep within, and then take a call. So the risk level haven't changed. I don't think they're going to change much. But yes, their understanding of, their ability to understand a product much more deeper and more technically kind of helps them take a better decision there.
So it's easier for them to get onboarded to such kind of investments?
Oh, absolutely. I mean, I guess ASK was one of the very few first A-graded AMCs to start this absolute return strategy, but there have been algo traders from several past years who have been running this strategy of arbitrage and giving us that kind of a return. So it's not something they are doing which is new. It is one of the very few credible names in the market which what they are doing is new. I mean, of course, if I have to trust Mr. A, it is tougher. If I have to trust ASK, it's easier. And if they are running a strategy, I can trust them.
Very true, very true. So, learning from investing mistakes is a crucial part of a family office evolving into a mature role. What would you suggest are certain mistakes and learnings or lessons that one should learn while being on their family office journey?
See, I think learning is an everyday process, and you make mistakes, and the only thing is that what we have learned is that FOMO doesn't take you anywhere. I mean, there will always be an opportunity to make money. There is never ever dearth of opportunities to make money. You should just be confident enough to take that step and have full knowledge about that aspect.
Great. So now I have a general question for each one of you. You all can answer it one by one. But what are the few trends that you all have observed in family office investing that has changed over the last 2-3 years and are here to stay for the next 5 to 10 years?
Well, last 2 to 3 years, I would say last 4 years have drugged all of us. The equity markets have. And I think the trends that we are talking about have been emerging from that, which are, I don't think, here to stay. Because, see, the trend is to do things on their own. So recently, when I was talking to other family offices, so for last 4 years, we have been advising other families on a lot of family office matters. So when that discussion goes, it goes in such a way that, yeah, we have actually, made 10x on our investments. I said, you made 10x on your investments in 3 years' time. That's fantastic. But look at those 3 years, how they were, how the risk on sentiment was everywhere. People were throwing money after everything that they came across. So the trend is actually to take more risk. That I can say for once. But that trend may not be here to stay, because after all, markets will never behave in the same fashion all the time. So when that realization will come, maybe the trend will change.
I think I would like to add to what Amol said. One is the FOMO factor. Everybody is investing in, similar asset classes because they see somebody else making returns, and it's a, jump onto the same bandwagon. What people forget is that a lot of these assets are also cyclical. So what goes up is likely to come down. I work for the World Gold Council, so I will speak from why you should have gold in portfolios. I think we did an analysis on, portfolio constructs per se, and what we've seen is, adding gold to portfolios not only improves risk-adjusted returns, but it also reduces volatility, it reduces the drawdowns, and from a portfolio stability perspective, you need to have a precious commodity like gold because it has a dual use. It's not just an investment class, you also have a consumption aspect to it. So, when we've seen when prices correct, consumers come in, they buy more jewelry. We've seen this even in the last few years. Gold, having said all this, has been a stellar performer. Last year it reached 40 new highs and across all currencies. This year also it has already crossed 25 new highs, and this year alone the returns are in excess of 12%. So if you look at allocation, obviously don't look at putting all your eggs in the same basket, but if you're looking at allocation to gold, we recommend, we are not wealth advisors, but we think anywhere between 7.5% to 15% will give you the risk adjusted returns and a lower volatility in portfolios. Because gold doesn't behave like other asset classes. Whether it's in times of geopolitical risks, geoeconomic risks, or even systemic risks, we've seen across periods. We've done analysis from the 90s onwards, right up to the Israel-Hamas invasion, COVID, and COVID pullback. One asset class that actually outperforms other asset classes is gold, because increasingly the correlation between debt and equity has turned positive, and gold actually becomes a good diversifier if you look at these two asset classes mainly. And because it's a good diversifier in the sense that when markets do well, gold does well, but when markets fall, gold does better. So the effective diversifier is where you need a cushion to your portfolio, you need an insurance of sorts to your portfolio, and that's what gold actually offers.
That's true.
Yeah.
So a few interesting trends, right? One, of course, the cognizance of risk, okay? At the same time, the evolution of professionalism into family offices setup, I think that's increasing rapidly. So what is happening is basically you're seeing newer professionals coming, a lot of education happening to the families as well in terms of what are the kind of instruments you would want to probably invest, strategies, and so on and so forth. Now, while that comes as an advantage, there is also other side to it in the sense that because of a little more adventurism sometimes in family offices, what happens and what we've seen is, treading into areas which are so-called probably risky, in the sense that because they would probably go by data over the last few years, and because the data has been pretty, stable, sometimes the under-appreciation of risk is also something which kind of, gets them carried away as well. Point an example, and it's just one example, is that we have seen many family offices actually, adventure into something called options, right? And when we talk about options, it's more, writing of options, right? It's hazardous, just because that something has not happened in the last few years doesn't mean that something is not going to happen in the future. So that is something, one has to have that kind of discipline and understanding of underlying risk, scenario-based analysis, and so on and so forth to actually say, okay, whether does this really make sense? This is where do I really want to indulge in? Or probably I need some experts on the derivatives to probably, help me or assist me on those kind of stuff. Which brings to me the last point, which I earlier alluded to as well, the evolution of SMAs, right? SMAs is something from an offshore perspective is very prominent, which is called separately managed account. A form of PMS, but a separately managed account where larger family offices want unique solutions into their portfolios, and they are approaching those kind of professional. And I think this trend will, evolve purely because as more and more wealth is getting created, I think these solutions will be needed going forward.
True.
So your question was that what are the new trends in the family offices? One, I would agree to him that the acceptability of a professional in a family office have increased substantially. I've been doing this for the past 14 years, but in the past 5 years, the kind of change I've seen in terms of acceptance of a professional advice, that has humongously grown. And that's why the concept of portfolio allocation, diversification is something which they really now understand. And second thing is that they've, as far as the family offices which I work with, they've understood that they have to take certain risks to understand certain stuff. As on the question of options, what we have done is we have kept 1% of the corpus for the entire family to understand new concepts. Unless we do it, we'll not understand it. And till the time we don't indulge into seeing what it brings to us. Of course, you have to do it under the professional guidance for sure, but that's their way of seeing that, of catching a trend early, and rather than sitting and just evaluating, then somebody will come, teach them how it happens. So our outlook is more towards, okay, if this is what it is, if I can limit my loss, what is the capital I'm putting on a table? And that's my appetite. I mean, 0.5% of my portfolio here and there doesn't make a difference to us.
True. So to summarize here, a few takeaways from what we discussed today is that what we have seen in the last 3 years or 5 years is not going to continue in the future. We've had a very good run in terms of multiple asset classes. But going in the future, investing in the future, it's very important for family offices to develop a deep understanding of the risk-adjusted returns, number one. Number two, it's also very essential that they themselves, like how Vishang said, it's very important to know that the new products, there is a clear understanding whether it suits your investment mandate or not. Then take that risk and not just get into it blindly. We now open the floor for questions. I think it'll be audible.
Can we pass on the mic in the audience, please?
I want to know what has been the general performance of gold over the period of time compared to other asset classes.
Sorry, did you get that? Can you please repeat your question? We didn't hear that clearly.
Okay. How the gold prices have performed in the last few years compared to other asset classes?
So like I said, gold has been a standout performer. We have seen, 40 new highs last year and 25 new highs this year. We also think that a lot of this is because of, the uncertainty that has panned out in the past few years. In November, we saw the new presidency in the US and a lot of tariff wars as a result. Before that, we had seen the Russia-Ukraine crisis, the Israel-Hamas invasion. So whenever there is uncertainty in the market, there is a flight to safety. And gold is considered as a safe haven asset. So obviously, the demand for gold goes up. And that has been a contributor to the increase in prices. Besides this, we also think, central banks who have been the larger buyers of gold have also contributed because, 1,000+ tons of purchases over the last 3 years is a huge number. In the past 16 years, they've been net buyers, but we've not seen these kind of numbers that we've seen in the recent past.
Let's say 10 years, 15 years.
So like I said, 3 years alone, it's 1,044 tons. Before that, they have been in the range of, anywhere between 650 to 800 tons.
Number of return, percentage return.
Percentage returns, again, last year, we saw the returns for gold were excess of 21% across all currencies, most currencies, leading currencies.
5 to 10 years.
5 to 10 years, it gives anywhere between 15 to 18% returns.
That's very good.
Yeah.
Thank you.
For a very long-term trend, the CAGR of gold trend is around 8% in dollar terms. So you could add the rate of depreciation of INR against it.
Yeah, absolutely. From 1975 onwards, the average rate has been 8%.
Yeah. Hello. Yeah, hi. This is Niranjan here. interestingly, you mentioned about options and derivative trading. And so wanted to know what are some forums or opportunities to get professional advice and things on, especially on derivatives and options that you mentioned. Yeah.
I am not an advocacy of any firm, but I'm just saying that, derivative experience, right? I think what my colleague kind of mentioned is that you need to more experience it to probably understand, but not kind of blow out your net worth in that process. So, of course, have some amount of money where you can probably learn about derivatives. Of course, academic knowledge is one part, but implementation of that into actual trades is a little different in that sense, right? So, it'll only come through your experience, how you trade in the markets.
So markets are your best teachers.
And don't take me wrong, I was not telling you to do derivative trading on your own. We have always done it with a professional. Now, how you find a professional is on you. What I meant to say in terms of learning about derivative is unless you do it with a trader who understands it very well, you will never end up taking a bigger exposure. So you have to understand the nuances of leverage, what comes along with derivative. So for us to understand it, we had to work with a trader first, one-on-one, that what it is all about. But we have never ever practiced it on our own, nor do we say to practice it on your own. I don't want anything.
Are there any other questions?
Yeah. So my question is, within the point of discussion, there was a point that Sir made that, what we saw in the last 2-3 years may not repeat. My question is related to that. What we saw was that a lot of earning growth was the substance behind whatever we saw from 2020 to 2025, be it small caps, be it mid caps. There was a huge substantial earning growth which was very different from what we saw the decade before. So why do we want to think that this may not continue going forward in the next 3-4 years? Because the rally is very much led by earning growth that we have seen.
What you say is correct in long term. So when earnings growth comes about, anywhere you see the fundamentals improving, the prices will reflect that growth, but not immediately. You will see the dislocations in the interim period. So over a period of 10 years, if you say that earnings growth or say, ROCE is something that you make as a share return on share prices. This is what a long-term scenario would be. But there is another factor, which is psychology in the market. Market will not, so for example, if the stock price is 100 last year on 1st April, this 31st March, the company has grown by 15%, the price will not be 115. Because in the meantime, sentiments will play a great role. Now, if it is a risk on, market will be willing to pay a large premium to it. So, for example, there are certain companies which are, take Thermax example, the family office I am managing. The PE was 70 at one point of time, 2 years ago, 2-3 years ago, 70. The closest competitor of Thermax was trading at around 34 PE. Why this difference? So people paid a premium for the governance, people paid a premium for their perception of the prospective growth, and this is all perception. So this may or may not happen. And when it doesn't happen over a period, see, if you stay put for one business cycle, the market will come to know whether whatever my expectations were, they are actually delivered or not. And accordingly, the prices will mean revert. So the mean is something that will come out to be the percentage of ROCE over a long period of time. In last 4 years, what has happened is there is immense liquidity that has gone into the system because of $7 trillion printing by the US. It's like water, it has to find its way somewhere in some asset classes. A lot of it also came by FIIs and FPIs to India, Indian capital markets. Another thing is Indian retail investors have matured more, a lot. You see the SIP books, you see when the market corrects, SIPs are not stopping. And that is extremely encouraging in terms of investor behavior. So all this money is already coming in. There are lesser sellers right now. So as the buyers go on increasing like this, the perception is very positive. It is a virtuous cycle in itself. It requires one shock. And market usually looks for the excuses to fall. Another thing is, it is said that markets go up by staircase and come down by elevator. Because the sentiment can change very quickly. That's why I said it may not sustain. See, right now, if you look at the price to earnings, earnings growth is there, but look at the price to earnings. And then how much premium is being paid. That premium will narrow down. I'm not saying the businesses are bad or doing bad. I'm saying the premium will narrow. That essentially means that the market may fall.
Got it. So just one small question follow-up. We saw a time correction starting from July, August till March. Just question to that: do you think that market has seen some kind of a shock and we're already done with that? We've recovered.
Well, it's not a shock, but I think that this volatility may continue for some time, because you may not see a 50% crash right now unless there is a black swan event. But this volatility may continue for some time.
I think we'll close the panel for discussion today. I encourage all of you to please speak to the panelists themselves during the breaks. Thank you so much, everyone, for having us here today. Thank you.
Thank you.
Thanks for having me.
Once again, thank you to our distinguished panelists for shedding such comprehensive light on the evolving investment strategies and diverse asset classes relevant for family offices. I request you all to please stay back on stage, and I request Mr. Nimesh Mehta to please join us on stage to felicitate our panelists. Can we have a big round of applause for Mr. Nimesh Mehta? Ladies and gentlemen, I request you to please keep applauding for all our panelists. I request you all to please come ahead for a photo op. Ahead of the table, sir. Once again, thank you so much. Also, ladies and gentlemen, do not forget to visit the booth, and please do not forget to share your learnings and key takeaways on LinkedIn and Twitter. And of course, visit the Eqclique booth for your chance to join the Family Office Leaders cohort with exclusive offers. All right, ladies and gentlemen, we call for a break of 20 minutes. I request you all to please gather quickly once again in this ballroom after 20 minutes. Please enjoy your break, have refreshments, and do visit this ballroom once again after 20 minutes. Thank you.